Tark and I wanted to come on here and talk today about housing affordability, interest rates, and how that's kind of looking like on the marketplace from a macro and micro level. Yeah?
Yeah, yeah,
So
well said. Let's go macro first, Omar. And as always, thank you so much for having me on. I want us to talk about interest rates. Obviously, we know a year, 2 years ago, interest rates were really, really low because of COVID. These low interest rates helped the housing world go crazy. Home prices were going up like bananagrams. Omar and I've been talking about this for over a year now. That it was great having low interest rates, but could you actually get into a home? Could you win an offer? Could you get sellers to pay for closing costs? And the answer was no. So let's talk about what actually drives mortgage rates. So here we have our mortgage rates. January of 2018, you can see that around 2018, 2019, we were at about a 5 flat. And everyone was so happy about that, right? But then, oh my goodness, COVID hits. And looks what happens. We have interest rates going below and staying around 3%. Now, this pink line, let me get my little laser pointer out here. Laser pointer, here we go. This salmon color pink line deal represents inflation, things getting more expensive. This line right here represents interest rates, and this shaded box right here represents a recession. If you remember, something kind of crazy happened February, March, April, May of 2020. That was COVID. The economy shut down. All right. Now, Omar, you'll see this right here that says QE, that stands for quantitative easing. All that means is that the Federal Reserve, they were buying up mortgage-backed securities like crazy. So as banks were issuing loans, the federal government was coming in, they were buying up those loans and putting them into mortgage-backed securities. And that really kept, even when inflation was going up, it kept interest rates really low. But look what happened. The second that the Fed stopped buying mortgage-backed securities, inflation was going up, and then the mortgage rates, boom, started going up. And here's what I want people to realize and understand, the big takeaway. So far as inflation goes up, mortgage rates go up. As inflation goes down, and this is where we've been the last few months, inflation finally started to come down. And look what, Omar, what's happening to mortgage rates. They're finally starting to come down. Let's talk about what that also means. Well, what was happening when inflation was going crazy? Things became incredibly expensive. As things became more expensive, our wages weren't necessarily going up. And so, look at this, Omar. This blew my mind. Credit card and other revolving debt. Okay.
skyrocketed.
Notice it was already kind of going up, right? But then COVID happened, and look what happened. It started going way down. Why did it go way down? Because people were getting checks in the mail from the federal government. They were using that to save for a down payment. They were using that to pay off their debt. And then as soon as that money stopped and as soon as inflation started to go up, we're at historic highs. Now, this people talk about the housing market being a bubble. It's not a bubble. What is a bubble is debt, right? We've got people. It is life has become so expensive that people are taking on more and more debt, and so this is one of the biggest indicators for a recession. Not only that, look at our personal savings rate. COVID happened, people were saving, the money dried up, and look, household debt going up, personal savings going down.
Mhm.
That's not what you want to see, and that really does mean we're probably headed towards a recession. Even though inflation is going down, we're probably still going towards a recession. But what's crazy, Omar, is because inventory has still not even recovered from 2008, even when mortgage rates skyrocketed, look at home prices. They were only went down 2.5%, and they've stabilized since then. Not only that, they're still up. Even if you take into consideration this 2.5% decrease, they're still up 39% the last 2 years. And look, Omar, if you bought 10 years ago, 115% up. So if you can get in the game and buy a house, amazing, amazing investment. But this is what I really want us to hone in on. It's all about affordability and it's all about interest rates. So last year, if you had a loan amount, 400,000, interest rate 3.5%, your monthly payment was 1,796, and your household income was around $9,000. That's what last year looked like. This year, to buy that exact same house, your mortgage is probably 40K higher because when we've also got a higher interest rate, which means our monthly payments almost $1,000 more. And here's the good news though, Omar, is since last year, wages have gone up. There's been a 9% increase. So if people were making, let's say, $9,000 a month last year, they're probably making $9,810 a month this year. But is that enough? Are we seeing wages increase enough to offset this increase due to interest rates? And the answer is no, not quite. We're still a little bit upside down. But this is where the news gets really good. We are seeing wages continue to go up, which means this family last year is bringing in 9,000. Next year, they'll probably be bringing in 10,300. Cost of living adjustments, raises, all of that. And not only that, but interest rates are projected to go down to about a 5%, meaning we no longer have this inverse, right? Yes, life has gotten more expensive for your mortgage at 807. But when you compare to where you were during COVID times, you're bringing in $1,300 more a month. So this, in terms of affordability, this is looking really positive for folks who can keep their debt down, can hang in there and just get to when these 5% rates are coming. We should see these as early as May or April. Let's talk about our housing forecast and when it comes to interest rates. Lower inflation, a recession-like slowdown, incomes increasing to help affordability, very tight inventory environment, and rent still expensive and still rising. So we've got low single-digit appreciation for most of the US with pickup in activity. And in terms of our mortgage rate forecast, we've got global quantitative tightening. What does that mean? That's a fancy way of saying the different governments of the world are not going to be buying mortgage-backed securities as much. All right. We also have a lack of foreign central bank buying and more debt is to be financed. Here are tailwinds, though: lower inflation, excessive retail inventory, increase in mortgage servicing value, and a recession likely. And Omar, what have I been saying for months now? The one silver lining of a recession: rates always decline during recessions. So if you bought a house now, you're almost certainly going to want to refinance and as soon as the recession comes and as soon as rates go down. So Omar, you are a local real estate expert. Let's actually put the pedal to the metal and let's talk through Round Rock, an area you know incredibly well. What's kind of like your average price point for a home in Round Rock right now?
Let's see, last time I checked, and I have it right here handy, so this is very recent data. For Round Rock, we're looking at 385,000 for median price of a home.
Okay, so 385, great. So let's just say that our annual income, now everyone who's watching, this is pre-tax. This is before anything is taken out. All right. So let's say that we have a household income of 97,000. What does that mean? That means let's say we have two teachers, Omar.
Okay?
Teacher one we have teacher number one making $48,000 a year. That's a teacher salary. Teacher two, let's say they're married, making $48,000 a year. So if you think of it that way, two teachers living together, $97,000 for your annual household income that's not some crazy number. Now let's take our interest rates right now to 6.25. Length of loan 30 years, and let's say that you still have $10,000 saved up for a down payment. And let's say, Omar, that we've got two car payments and like a couple of credit cards. So our monthly debt obligations, $1,000. Now, if we're buying a $380,000 house in Round Rock, our property taxes probably going to be about $8,000 a year. Homeowners insurance, let's say you buy a newer home, we'll say $1,500 a year. DTI, that stands for debt to income, 55%. That's how high you can go for FHA and VA.
Can
All
you
right.
scroll up? Can you scroll up a little bit?
Yep,
Okay.
absolutely. And then we've got mortgage insurance, 0.85%. That's going to be for FHA. If you're VA, you do not pay mortgage insurance. That'd be at a zero. But let's just run these numbers. So let's see. All right, Omar, we got two teachers living together. We have high interest rates. We've got some debt. We've like, oh my gosh, there's just no way. There's no way they're going to be able to afford a 300 and what'd you say, 383,000?
385.
385, right? Let's look. Well, look at that. 386. And let's just look at what that means. Here's our mortgage payment breakdown. Is our total payment, principal and interest, taxes, homeowners insurance, mortgage insurance, $3,378 a month. All right. Also with your, and by the way, you can get a nice house for $386,000. Like that's a nice house. This mortgage insurance goes away if you are VA or after 89 months of payments. And this is huge right here. Closing costs are usually going to be about 2.5%. So you got a down payment, but also got closing costs. A year ago, sellers are not going to pay for closing costs. They are paying for closing costs now. So this is an amazing opportunity to essentially have total funds needed go from 20,000 to 10,000. So keep that in mind in this current market. Let's say that you buy that house, all right? You buy that house, and a year from now, we're down to 5%. I want you, this is at what our purchasing power is at, 386. Let's see what happens when we go to a 5%. Whoa, look at that. You can afford a $435,000 home. Not only that, but let's say that you bought that $385,000 home. Okay. Your monthly mortgage payments gone down $300 just by refinancing 1 percentage point. Okay. So that would be kind of the outlook of where I think we're going. Give me another like borrower or buyer profile. So annual income, give me some professions. Let's also try to figure out how much money we got saved up for a down payment, monthly obligations, all that stuff.
We're in
Okay.
Austin, and Austin is big on tech. So let's think of some type of engineer, software network engineer. Let's
Okay.
say that just him alone, right? Because he makes really good money. So the other person can stay at home. Let's say they make $130,000 annually.
All right. Great. Love it. How much do you think they've got saved up for a down payment?
Let's say that they've been preparing for a while and they've been sacrificing, and they're going to have at least, I would say, 10% down for a home.
All
So
right. So let's say 30K. What are their monthly debt obligations look like?
they do have credit card debt and a car payment. So,
Okay.
and a nice car. Let's say they have like a really nice, I don't know, Tesla or
Maserati
Lexus,
or Tesla.
Maserati.
Yeah,
Yeah,
something
like a
like that.
$1,000 car payment at least, and maybe another $1,000 in credit card debt for monthly.
Love it. Okay. Property taxes, if they're buying kind of a higher end house, let's crank property taxes up to like 9,500 a year. We'll crank homeowners insurance up to let's say 2,000. All right. Okay. Drum roll. Let's see where we're at. Okay, so we're about 453. All right. So
So was
you're
that
comfortably
DTI?
above.
Was that DTI? Because if they pay 10%, couldn't they qualify maybe for a conventional or
Yeah,
no?
so let's do so conventional, we'd want to be like below 48%.
Okay.
Um, so that's the thing. But our let's get rid of our mortgage insurance or have our mortgage insurance go down lower for conventional because we're putting 10% down. And I'm gonna actually keep our property tax around 8,000, keep this around 1,800. All right. All right. So for conventional, we're going conventional loan. Now remember, conventional has a lower DTI threshold, debt to income. So around 400,000. Now let's say that you don't have a Tesla. Let's say that really, we've got an F-150 or whatever, and let's say that our monthly debt obligations are like 1,500. That did you
Wow.
see how Did you see how much that? I mean, $80,000 in extra buying power.
A big point that we're trying to drive here is that we're really playing with numbers, and we could see if you have a lot of debt, how much we need to reduce it so you can afford more house, or if you're simply trying to get into the real estate game because you are of the belief that, hey, I understand how house appreciation works, especially in Austin, and you just want to get in, then you certainly can, and we can work with that, right? It's
Yep.
just
Yep.
knowing at least where you stand and running these numbers. Parker does every day, right? And look, and this is a very awesome tool that takes almost no effort. We just need to get your information. So don't hesitate to reach out or just leave a comment below and just write, what do you make a year? What's some of the debt you carry? And what's another good question? Where are you looking to buy? So we can run an
Well,
example like this for you.
and one thing I do want to show is, let's just say that this price point, 482, a $3,600 a month let's just say that that's kind of freaking me out a little bit. You're like, I'm just going to rent. Well, let me show you. So let's talk about the why. Can you give me a Round Rock zip code?
Let's do 78626.
Your starting home price, 454. Let's go back to our number of 482. All right, 482. Let's do a 10% down payment. Let's say that we get our closing costs paid for, because that's a thing now, Omar.
Mm-hmm.
All right, let's say that we are going to go 10 years. For that zip code, Omar, historically, it'll go up 4.28%. Forecasted 2.06%. The forecast is always going to be super.
Conservative.
Look at this. Appreciation after 10 years. If we go by historical data, that $483,000 house is going to be worth $732,000. If we go by the super conservative forecast of 2%, it'll be worth $590,000. Okay. Now, this is what I want to show. Percent return on investment. Remember, what was your initial investment? Your initial investment was that 10% down payment, right? Just after 1 year, you've gotten a 14.17% return on your investment. That's way better than my Robinhood account. Historically, return on investment is 42.75%. We keep going 10 years, you've had almost a 500+% return on investment, or a worst case scenario, a 226%. And this is just when it comes to appreciation. Here's the other thing I wanted to show you too, is let's talk about equity gained. Can you give me that zip code again, Omar?
So it was 78626.
Let's go 482. All right, we've got our historical, our forecasted. Let's say that we're doing a 10% down payment, 433,800, 30 years. And oh, we've got those terrible, super high interest rates. It would be such a terrible investment for me to buy a house. Well, not so fast. Let's look at this. All right. If you hold on for 10 years, Omar, and we have a really conservative 2% forecasted appreciation, you're walking away with almost $250,000. If we go with our historical appreciation for that zip code, you're walking away with $365,000. This is only after 10 years. This is why home ownership is such an incredibly powerful tool. This is why home ownership is worth getting in the game, even if this payment scares you, even if this interest rate scares you. Because let's just say you stayed at that high interest rate. What do you have to gain? Great. Let's just do 2 years then. Let's just do 2 years, Omar. Let's see what happens. 2 years, projecting that you'll have a total equity position of $81,000.
That's still really good.
That's
Can
amazing.
you
Yeah.
can you break down the appreciation gain and the amortization gain? How do those numbers calculate?
Yeah, that's a great question. So appreciation gain means how much has that property gone up in value in 2 years. So it's gone up $23,000. That's conservatively. Historically, it will have gone up 42,000. Amortization gained, all that means is how much have you paid the loan amount down? Like you've been
Hmm.
making your mortgage payments, how much of that loan balance has gone down? So equity gained, you just by making your payments and letting time pass, $33,000 in equity gained. Historically, it'd be more like 52,000. So if you were to sell after just 2 years, you're getting your down payment back of 48,000, plus you'll have gained $33,000 in equity, which means you're walking with the $81,000 check, right?
Okay, so it's that the big numbers, including the appreciation, the amortization, right, and the initial down payments.
That's exactly right. Think of it this way: if I'm buying $100 in Coca-Cola stock, right, and I cash it out 2 years later for $200, well, I've gotten back my initial investment of 100, and then I've also gotten an additional 100, or I've doubled my initial investment. So if my initial investment was $48,000, and then I sell after 2 years, I've essentially gotten $33,338 on top of that initial investment. And that's just after 2 years. You got to get in the game. It's worth getting in the game. It's worth finding a way to get in the game. And if you don't have the down payment saved up, we have down payment assistance programs. If you feel like there's not a house out there that will meet your purchasing power, well, you haven't met Omar. He will find you a house. So don't give up, stay encouraged, and know that even though interest rates are higher than they were 2 years ago, you've got motivated sellers who are willing to come to the table and work with you, and lower interest rates are coming. So I don't know about you, but I would much rather be in my dream home that got a killer deal on. And yes, the monthly payment's not great, but a year from now, when everyone's going crazy trying to buy a house because interest rates are low, I'm still sitting pretty in my home that I bought, and I can just finance that lower rate. Rates are going to start coming down. We think we'll be around 5% as early as April, May, June. Micro, if you are especially a dual income household, you got two adults making about 48K a year, fill out an application, give Omar a call. Home ownership is so close, you don't even realize it.
Affordability, especially housing affordability, is such a trending topic. And if you're just watching the news, it probably is scaring you that you're never going to be able to purchase ever because the median wages aren't keeping pace with how crazy houses are being sold for now. But you don't know until you know, right? So we kind of gave you a what Parker sees, right? We want to give you as much transparency on how the numbers work and how we can not manipulate, but you could see just by making little tweaks, in either paying down your debt or maybe looking for a house that isn't going to be your forever home, right? Because everyone needs you could think of it as having a starter home, right?
Right,
And
right.
not thinking of the dream home, dream forever home right off the bat. That way, after a few years, you implement the strategy of like, hey, now I have this appreciation, I have a little bit of equity. Now I can probably think about maybe moving up to the bigger house or whatever your dream house may, uh,
Yep,
whatever shape that may take. Parker and I are going to make a sincere effort to do more of these kind of webinars, and we want to hear from you. What are you making? What's your debt like? Because I think that's a big point that I really wanted to come across is that hey, we don't buy. We like to put out video content because we know this is how people really want to view information, and
yep.
we're trying to meet you halfway to get access so you can see this in real time.